welcome to study with me about insurance awareness. Today, let's learn about important insurance terms. Operating ratio. Some of the expenditure or losses expressed as certain percentage of the earned premium is called operating ratio. Once again, sum of expenditures or losses expressed as certain percentage of the earned premiums is known as operating ratio. Reinsurance. Reinsurance is the insurance that an insurance company itself purchases from another insurance company for what it purchases to insulate itself from the risk of major claim event. Renewal. When the term of your insurance policy expires, you need to decide if you want to keep your current insurance coverage on the insurance provider. Surety bond insurance. The surety bond insurance serves as a risk transfer instrument for the principal, protecting the principal from potential damages in the event that the contractor breaches the terms of contract. Third party insurance. Third party insurance, which is also sometimes referred to as Act Only insurance, is a statutory requirement for all vehicle owners as per the Motor Vehicle Act. It is a type of insurance cover where the insurer offers protection against damage to the third party vehicle, personal property, and physical injury. Term insurance. Term insurance provides coverage for specific number of years, known as policy terms. In case of an unfortunate event during this period, specifically death, your nominee will receive the sum assured in your policy. Under insurance. Under insurance is the condition where the life insurance cover is not enough to take care of the financial needs of your loved ones. It means the sum insured by your policy is not adequate. Over insurance. It is just opposite to under insurance. Over insurance can be described as having an excess insurance coverage or policies that cover the same risk or having insurance cover in excess of the value of possible loss that incurred. Accumulation period. In a life insurance policy, the accumulation period is the time span in which the life insured pays a regular premium towards the insurance product. This helps in the accumulation of funds for life after retirement. This broadly applies to annuity or retirement plans. Once again, accumulation plan in a life insurance policy, the accumulation period is a time span in which the life insured pays a regular premium towards the insurance product. This helps in accumulation of funds for life after retirement. This broadly applies to annuity or retirement plans. Underwriting. The process of determining whether to accept a risk, and if so, what amount of insurance the company will write on the acceptable risk and at what rate, is called underwriting. Underwriters are companies, individuals, or insurance companies that carry on the critical activity for their own account or for that of others. Underwriter, a person whose job is to calculate the risk that is involved in an activity or in providing insurance for a particular customer and to decide how much should be paid for the insurance is called an underwriter. Unearned premium. Part of the premium that a company has collected but still has to be earned since the policy's term hasn't expired is called an unearned premium. Valued policy. A valued policy is an insurance policy in which the amount payable for a claim is agreed upon when the policy is issued and is not related to the actual value of loss. With a valued policy, the insurer pays a specific amount of money to or on behalf of the insured upon the occurrence of a definite loss. Once again, valued policy is an insurance policy in which the amount payable for a claim is agreed upon the policy and is issued and is not related to the actual value of loss. Valued policy means that the insured person will get upon the only the agreed value of the policy, not the actual value of the loss. That's it. Twisting. It is the act of inducing or attempting to induce a policy owner to drop an existing life insurance policy and to take another policy that is substantially the same kind by using misrepresentations or incomplete comparisons of advantages and disadvantages of the two policies is called twisting. Waiver of subrogation. A waiver of subrogation is when the insured surrender the right of subrogation. Generally, the third party responsible partially or wholly for the damage in question would want you to waive off the right of subrogation for the peace of mind, as they can be held liable by the insurer for the damages. Waiver of subrogation is when the insured, that means the policy holder, surrender the right of subrogation, is called, the insured person is called waiver of subrogation. Why they do? Generally, the third party responsible for the damage is in question would want to you to waive the right of subrogation for the peace of mind. For what? For their peace of mind, as they can be held responsible by the insurer for the damages. Group insurance. Insurance firms provide group plans for accidents, professional indemnity, and medical insurance for group of people engaged in similar activities, such as workers of a corporation, members of a professional association, and farmers, etc. Grace period. A specific period after the premium due date during which the insured can pay the premium amount. All benefits and covers under the policy continue during this period. Capitation. Capitation is a system of health insurance payments in which health professionals are paid fixed amounts per month based on the number of insured people they have as patients. Once again, capitation is a system of health insurance payments in which health professionals are paid fixed amounts per month based on the number of insured persons they have as patients. Hull insurance. Marine hull insurance is an insurance policy specifically designed to provide coverage to water vehicles like a boat, ship, yacht, fishing boat, etc. Dwelling insurance covers damage to your home, including the foundation, frame, walls, and roofs, but it covers only your house structure, not its contents or land. Insurance retention. The maximum amount of risk retained by an insurer per life is called retention. Once again, insurance retention means the maximum amount of risk retained by an insurer per life is called retention. Peril. In the world of insurance, a peril is an event or circumstance that result in property damage. A peril can be a natural disaster, flood, tsunami, earthquake, cyclone, landslide, anything. These things are called perils. Waiting period. It is the amount of time that an insured must wait before some or all of their coverage comes into effect. The insured may not receive benefits of claims filed during the waiting period. Subrogation. To make up for the compensation paid, your insurer can claim the right over the third party. In case if you or in an accident by a third party, the insurer has the right to claim from the third party. You surrender your rights over the third party to the insurer. This transfer of all the rights and remedies from the insured, from you to the insurance company, is called subrogation. Subrogation is to make up for the compensation paid. Your insurer can claim the right over the third party. That means the insurance company can claim the right over the third party who has caused damage to your property. You surrender your rights over the third party to the insurer. You are telling the insurance company to claim on behalf of you. This transfer of all the rights and remedies from the insured to the insurer is called subrogation. Nomination is the process of determining one person who will receive the benefits from the life insurance policy in case of any casualties. Means in case of any damages or death of the insured, the nominated person will get the benefits from the life insurance policy. Nominee. Nominee in insurance means nominating a person to receive an insured amount if the policy holder passes away during the policy period. These things denote the same. These two define the same meaning. Premium. An insurance premium equates to the money that is paid by any person or a business or company for availing a insurance policy. The insurance premium amount is influenced by multiple factors and varies from one payee to another. This is a very important question that can be asked. The premium, an insurance premium means the money that is paid by any person. That can be a person or a company or a business entity, whatever it may be, pays money for what? For availing an insurance policy. This is a very important term that you should say. For availing an insurance policy, availing, that is the word you have to remember in for premium. The insurance premium amount is influenced by multiple factors and varies from one person to another. Binding receipt, a receipt provided for the payment of premium and accompanies the insurance application. When the policy is approved, it binds the insurer for making the policy effective from the date on this receipt. Beneficiary, the person or the entity designated in the insurance policy to receive the profits in the event that the insured passes away, is known as beneficiary. Insurance coverage, it is the amount of risk, liability, or potential loss that is protected by insurance, is known as insurance coverage. Once again, insurance coverage is the amount of risk, liability, or potential loss that is protected by the insurance. This can be asked in your interview. Claim, a formal request for compensation of damages covered by your insurance policy, is known as insurance claim, which is made to your insurance provider. An insurance policy is a contract between you and your insurer. Claimant, a person requesting compensation for any loss covered by the insurance policy's terms and conditions. Any person is requesting a compensation for any loss covered by the insurance, they should have the insurance policy, and the policy terms and conditions should match their loss, is called claimant. A person requesting compensation for any loss covered by the insurance policy's terms and condition is known as claimant. Deductible, the deductible is the sum that must be paid out of your own pocket before the insurance provider starts covering any incurred loss. This term is related generally to the health insurance. This is also very important term which you must remember. Deductible is the sum that must be paid out of from your own pocket before the insurance provider starts covering any incurred cost. Before the insurance provider starts covering your loss, you must give some money from your own pocket, that is known as deductible. Repatriation, the cost associated with bringing a claimant or their body home after they have been hurt or died abroad, are known as repatriation expenditure. For example, the claimant has died in another country. The cost associated with bringing a claimant's body to home, to their home country after they have been died, is known as repatriation expenditure. Bridge insurance is a type of insurance that covers damage to the bridges due to fire, flood, explosions, and more. However, it generally does not cover any damage as a result of war, inherent defects, or natural wear and tear. All these won't be covered by bridge insurance. Only if it is damaged by flood, fire, explosions, it can be covered by bridge insurance. Reimbursement, in healthcare, reimbursement means the payment that your hospital, doctor, diagnostic center, or other healthcare provider gets for giving you medical care. The healthcare hospital, doctor, diagnostic centers gets payment, that is known as reimbursement. Most of the time your health insurance or the government will pay for all or part of your medical cost. Endowment, a type of life insurance known as endowment insurance, pays the face amount to the insured either at the conclusion of the contract term or upon the insured's death. Either upon the insured's death or at the conclusion of a contract term, the insurance pays the face amount to the insured, is known as endowment. Fiduciary, If a company sponsors a retirement or a health plan for its employees, then the person involved anyway with the management of the plan is considered as fiduciary. Fiduciary is held personally liable for a breach of his fiduciary duties. Once again, if a company sponsors a retirement or health plan for its employees, then the person involved anyway with the management of that plant is considered as a fiduciary. A fiduciary is held personally liable for a breach of his fiduciary duties.